Hello and welcome everybody to the channel. Today we're going to discuss the intrinsic value of one of my favorite businesses, Texas Instruments. Full disclosure, I do own shares of Texas Instruments and this is not financial advice. Alright, let's discuss how we're going to analyze this stock. Texas Instruments is in the semiconductor industry and is best known for their fancy calculators we all love to buy at the start of each school year. However, Texas Instruments is so much more than their calculators. They are the market leader in analog semiconductors, which control the processing of electrical and power signals in virtually every electric device you can think of. Just look around you, and almost every electrical product you own requires analog semiconductors. Some specific examples include amplifiers, converters, like digital to analog, regulators, which maintain electrical current, and sensors like thermometers or motion sensors. That's why I love a business like Texas Instruments. Their products are a requirement in nearly every device necessary in our modern economy. Think TVs, smartphones, laptops, desktops, as well as MRI machines, insulin pumps, and blood pressure monitors. And you know what? It's only going to increase as time goes on. Their embedded processing segment offers microcontrollers used in all sorts of electrical equipment and calculators. They aren't a sexy AI chip maker like NVIDIA, but a good old boring company that simply manufactures great products used in such a diverse array of devices. We're going to look at 4 valuation methods: the discounted cash flow, dividend discount model, exit multiples, and the Benjamin Graham's valuation model. Let's get into it. Please, if you haven't already, hit that like button and subscribe to the channel. Also, hit the notification bell so you can be informed when I upload more stock analysis videos. All right, we start here on my investment summary tab, and we look at, they have a market cap of $155 billion, and they're currently trading at a price of $169.83, and their trailing 12 earnings per share is $8.33 a share. They're also a member of the S&P 500 and the NASDAQ 100. Future growth here, projections, I have a 4.87% corporate bond rate, which will be used for Ben Graham's valuation, an 8% discount rate, a perpetual growth rate of 3%, and we can discuss more of these later at the end when we are looking at our final valuation numbers. Moving on to our price ratios here, we see that they're trading currently at a 20.4 price multiple and a forward PE of 23.2, indicating they're going to have a slight dip later in the year, and I'm baking that into my analysis as well. And come down here to some profitability numbers. They are humming along nicely. They have a gross margin percent, 69.29%, above their 5 and 10 year average. Operating margin percent, above their 5 and 10 year average at 46.5%. And they're converting cash at a little bit of a lower rate at just under $1. And you can see here they're under their 5 and 10 year averages for free cash flow margin and yield, as well as their return on assets and investment capital and capital employed. However, there's a very strong numbers despite being below their 5 and 10 year averages at 29% for return on assets, 28% for return on invested capital, and a 31% for return on capital employed. They currently have a dividend of $4.96 a share and a dividend yield at 2.92%, which is also above their 5 and 10 year average, indicating a slight undervaluation at this time. They do pay out quite a bit in free cash flow at this point, 142%, but we will get into some of those reasons why later in this video. From a financial health aspect, their current ratio is at 5.7, a quick ratio of 4.3, debt equity under 1 at 0.7, and no issues covering the interest on their debt payments at 33.5. Some more metrics to look at here. If we want to look at their compound annual growth rates over the last 1, 3, 5, and 10 year periods, revenue per share has been growing nicely. I do like to see this number at about a 10% on the 10 year, but 6.7%, not too bad for a very well established company. Gross margin percent has been rising on a compound annual growth basis at 3.31% over the 10 years. OPEX has been declining, 5.25% decline, compound decline of a year. Earnings per share has been growing at a very healthy clip of 20%. Their shares outstanding have also decreased 2% per annum over the last 10 years, and they've grown their dividend at 20% over the last 10 years as well. They also just under 10% free cash flow per share growth per annum over the last 10 years at 9.53%. Another number I like to see a little bit above 10, but 9.5 is not bad. And you can see here they have accelerated their retained earnings growth, 6.35% 10 years ago to 9.66% 1 year over 1 year growth. And we come here and take a quick look at their share returns here. So 52 week, they're trading at a high of 186.08, which they hit just at the end of July, and a low of 148.34. Their 10-year compound annual growth rate on their share price is 15.74%. These are not dividend adjusted. I believe if you do dividend adjusted, they're just over 10% on a 5-year and just under 10% on a 3-year. However, this is pretty nice, healthy share growth, and I expect that to continue as we see the semiconductor take off the next 10 years. I do think right now in the semiconductor industry, we're at the trough of the semiconductor cycle. All right, let's take a look at some charts. Starting with annual data for the last 10 years, we can see the income statement charts first. We can see that they've had a very steady growth in revenue and net income over the last 10 years. But one of my favorite things to see is how their SG&A margin has fallen nicely over the last 10 years, a pretty consistent clip too. And their operating income margin has increased steadily over the last 10 years. And we can see that share buyback program as well here and their shares outstanding over the last 10 years. And again, very nice, healthy earnings per share growth. This is where you're seeing that 20% per annum growth. Looking now at some balance sheet and cash flow charts. The only one I really want to point out here is down we have our operating cash flow, capital expenditures, and free cash flow. You can see that number has steadily risen over the years, but as I'll talk about a little bit later in the video, you do see some pretty large CapEx investment in 21 and 22, and I do expect that to stay at pretty high levels in the next couple years to come. However, that should not eat into their total free cash flow, as they do have a pretty healthy amount of free cash flow that they generate every single year. Taking a quick look at the margins, we can see that gross margin percent has been increasing steadily over the last 10 years, as well as that net margin percent. And their payout ratio has been pretty steady over the last 10 years as well. And we do see a bit of a dip in their free cash flow margin, but again, I do think that's due to the decline in the semiconductor market in the last couple years. And if we look at their dividend chart down here, their dividend yield has gone up a little bit because of that dip in share price, but you can see that they have just paying a steady increase in dividend every year for the last 10 years and even before. And one last set of charts I want to point out. So we do see a nice growth in the revenue per share over the last 10 years and that free cash flow per share growth as well. Again, we have that dip in 2022, but I do expect that to start going back up starting in 2024 and going forward. And if we look at adjusted free cash flow per share, which is free cash flow less the stock-based compensation, and you can see that they don't really have a lot of stock-based compensation, which is good for shareholders, and that's just growing right along with the free cash flow. Next, I want to point out the peer group that I selected for our exit multiples valuation. I select these based on their peers on one of the screener sites I like to use, stockrover.com, as well as what's listed on companies' reports. Generally, I also like to choose peers that are in relatively the same market cap. I think that gives a much better comparison as well. And in this case, I chose Broadcom, Advanced Micro Devices, Intel, Qualcomm, and Analog Devices. This is the most difficult part of any analysis, and in my opinion, it is best to be conservative here. This is the growth rates. While I believe the semiconductor industry is poised for high growth into the next decade, I'm not going to be as optimistic with my projections. Ultimately, I'm trying to project free cash flow growth, and I don't like to slap a single rate and call it a day because it really is dependent on so many other factors, such as revenue growth and the ability of the business to convert net income into cash. The top sections estimate revenue, diluted earnings per share, operating cash flow, CapEx, and free cash flow for the rest of the current fiscal year. And the bottom section applies a growth rate for the next 10 years. To estimate these numbers, I do look at a variety of sources. So for revenue and earnings per share, I'll start with management guidance. If provided, I'll use those numbers and usually knock a couple basis points off the rate to ensure my analysis is a bit more conservative. If no guidance is provided, I'll look at analyst estimates, and again, I'll knock a few basis points off, so I'm a bit more conservative. For net income and the cash flow components, I generally use history as a guide. Using averages from prior 8 quarters, 5 and 10 years, it does return fairly reasonable results in line with how the company has performed historically. Now, past history is certainly no indicator of future success. However, if I'm at the point where I'm starting to do an investment evaluation like this, that means the business has passed my various screening requirements, both quantitative and qualitative, and I'm confident this business will be an above average performer for at least the next 10 years. Now, I'm assessing if the business is worth buying at the current trading price in today's market. Okay, so let's enter the growth rates for our revenue, and I am projecting a pretty big decline in revenue, 17.5% for the next quarter, and for the final quarter of 2023, just a slight 1% growth. And for our earnings per share, I'm looking at about a negative 31% decline, and then another negative 12% decline for the last quarter of 2023. So after that, I'm looking at this net income margin here. So I'm going to be entering net income margin. And basically, the way I estimate the net income is I look at the margins and over the last 8 quarters, and I kind of just throw in a rate that looks fairly reasonable and in line with how they performed in the past in these types of quarters. So I put in a 34% and a 37% rate. It gives a 37% margin for our year 1 projection. Coming down to our operating cash flow, this is based on the cash conversion number, which is operating cash flow divided by net income. So how many dollars of net income do they turn into operating cash? And in this case, I selected 85 cents in Q3, and for Q4, 80 cents. And then capital expenditures. So this is going to be CapEx as a percentage of revenue. We can see in the last few quarters, it is pretty high compared to historical averages. And the reason for that is, per their annual report, Texas Instruments has stated they are going to be investing heavily in capital expenditures over the next couple of years, which it makes sense because typically in the semiconductor industry, when the cycle reaches its trough, that's a lot of times companies are investing heavily in CapEx for that future growth. And so in this instance, I'm estimating 30% CapEx as a percent of revenue in Q3, and in Q4 I'm looking at a 22.5%, which gives us 26 and 2/3% on the year. That leaves us then with free cash flow for fiscal year 2023 at $418 million, which is fairly low and below their typical historical rate here. 92% decline over the previous year, and only a 2.3% margin. So not the best free cash flow numbers, but again, I do think we're at the bottom of the trough of the semiconductor cycle, and we're going to see these numbers grow pretty nicely over the next decade here as that industry takes off even more with the coming AI boom. Okay, so that brings us to the projections for our years 2 through 6 for revenue. And again, I got these numbers from analyst estimates, and then I knocked a few basis points off them to be a little bit more conservative. So 7.25% in year 2, 10% in year 3, 12% in year 4, 9% in year 5, and then a flat 6% rate going forward from years 6 through 10. And that gives us a CAGR here of 5.62%. For the next 10 years, which I think is fairly reasonable. It's in line with their historical averages here, maybe a little bit high due to the fact that this 10-year number is baking in the decline, or the bottom of the trough here for the cycle. But I do think it's a fairly reasonable number. And then for earnings per share, I'm looking at 10% growth, 13% in year 2, in year 4, 15%, 12% in year 5, and 8% in year 6, and through year 10 here. And if we look at that, the reason these are a little bit higher than our revenue is historically, that's how it's been true. So their EPS growth grows faster than revenue, and a lot of that's due to share buybacks and things like that, which obviously benefit investors. So that said, we're looking at a 6.28% CAGR for the 10 years for earnings per share, and I think that's very reasonable, very conservative considering the historical growth that they have here. So now we see that our margins here are falling precipitously because I don't have our net income multiplier here. What net income multiplier means is I look at net income growth compared to the earnings per share growth and I apply a multiplier that kind of puts the net income growth more in line with historical averages here. And if I look at it, it's always slightly below what the earnings per share growth is. So in that instance, I chose a 90% multiplier, meaning net income is going to grow about 90% of how the earnings per share grows over the next 10 years here, which gives us a 5.11% 10-year CAGR, which you can see is about 90% less than the earnings per share. And so that does give us a final margin here, net income margin of 41.6%, which if we look at historical net income margins, is very much in line. You know, they hit 44%, nearly 45% in March 2022. So I think 41% is a very reasonable number for the net income margins. In fact, it may even grow. So again, I like to be conservative in our estimates here. And then we come to our cash conversion. So for cash conversion, again, this is how much cash is converted from net income. And in this instance, I chose $1.20. So I slightly above their 5-year average, slightly way above their prior 8-quarter average. And the reason I went with $1.20 is I think that as the semiconductor industry gets back into their growth cycle, we're going to see Texas Instruments benefit from that growth as well. And so they're going to come much more in line with the historical numbers. And so that's what I'm using there at the 7% operating cash flow, 7% growth rate over the next 10 years. And then CapEx percentage of revenue here, I estimated about 12%, which, like I was saying earlier in the video, is a little bit higher than their 5-year and 10-year averages, a little bit below what they've done the last 8 quarters. And I think that's a reflection of what management themselves have said, and that they are expecting heavier investment in CapEx over the next couple of years. So I'm estimating that as a 12% here. And once we subtract out our capital expenditure from our operating cash flow, that leaves us with our free cash flow growth, which we can see is 8.29% 10-year projected compound annual growth. And if we look at why I think that's reasonable, we can see here that our year-over-year growth tapers down to about 7.258% in year 10, and we do have a final free cash flow margin of about 38% in year 10. And if we look historically at the margins, they are a little all over the place, especially in the current year and the last few quarters. However, going back to prior to the industry cycle turning downwards, we had a 41.8% free cash flow margin and even a 34% in March 2022. So I think growing that margin to 37% over the next 10 years is perfectly reasonable. So now, where does all that leave us? How do these growth rates affect what our actual discounted cash flow valuation is going to be? Well, let's find out. Okay, so we come over to our discounted cash flow page, and we can see here the historical numbers for the revenue, earnings per share, and free cash flow. Again, I wanted to point out that free cash flow margin percent, it is 29% in 2022. If we look back, we do see a 40% number in 2019, a 38% number in 2020. Again, making me feel pretty comfortable that our 37% margin of free cash flow margin in 2032 is a reasonable assumption, and that our growth rates are all pretty reasonable here. So using that 8% discount percent that I mentioned earlier and the 3% perpetual growth, that gives us a discounted cash flow price of $194.71 a share. And when we apply a 10% margin of safety, we do get $175.24 a share. I chose 8% because what I'm trying to do is I want to factor in an actual nominal growth rate over the next 10 years of 10%. And what I'm doing is factoring about inflation here. So I do think inflation in the US will probably be around 3 to 4% over the next 10 years. And with an 8% discount rate, nominally, that'll actually give me a return of about 11% in the next 10 years. Okay, so next we have our dividend discount model. And looking at this real quickly, we can see excellent dividend growth over the last 10 years, 20% per annum for a 10-year compound annual growth rate, 16% in the last 5 years, down to 10% year-over-year growth from last year. I do think that it will pick up a little bit again in the next 5 years because of the fact that we are in that semiconductor trough right now. And as that growth cycle takes off in 2024, we'll also see some more dividend growth out of Texas Instruments. So we have 5% in 2024, 8% in 2025, 10% in 2026, 12% in 2027. And I put a perpetual dividend growth rate at 6%, which may be a little bit high, but I do think it is under what their historical growth is here. And like I said, that free cash flow payout ratio will come down a little bit. That gives us a final buy price on a dividend discount model of $228.80 per share once we factor in a 10% discount rate. Coming over to our exit multiples model, we see that based on the peers I did select for our comparison here, we have Broadcom, Advanced Micro Devices, Intel, Qualcomm, and Analog Devices. That gives an average PE of 22.25 and a median PE of 24.79. I selected the average based since it's a little bit more conservative. And based on that average, we have a exit multiples price of $185.30 a share, and with a 10% margin of safety, $166.77 per share. And finally, we have Ben Graham's valuation model. So with a $7.31 projected earnings per share in 2023 and a PE ratio of a no growth company at 7, 5-year earnings per share growth rate of 4.5%. The average AAA corporate bond yield is at 4.4%. And right now the current AAA corporate bond yield is pretty high at 4.87% historically. And that yields us here Graham's valuation model of $76.52 per share, and with a 10% margin of safety, $68.87 per share. All right, so that brings us back to our investment summary tab here, and I want to discuss what our final results will be. And like I mentioned, I'd use a 10% margin of safety because I believe Texas Instruments is a very well-established company, and I'm very confident in the future of this company as their products are always innovative and always necessary for the market that they serve. So let's see. Our discounted cash flow is at $191.70 per share. Our dividend, $254.23 a share. Our exit multiple is $185.30. And Graham's valuation gives us $76.52 per share. So with the current share price of $169.83, what is our valuation average? Well, let's see. Okay, so that gives us a valuation average of $191.93 a share with a 13% potential upside. And using that 10% margin of safety that I discussed earlier, we have a buy price of $172.74 per share with a buy recommendation. So with that final buy price of $172.74 a share, I do think Texas Instruments is a very reasonable price today. They might even come down a little bit more in the next quarter or so towards the end of the year, just because of the fact that we do expect a lot of earnings per share numbers to come in a little bit lower than their normal rates. So that will make short-term investors skittish and thus lower that share price. But if you want to pick up some today, I think you'll definitely see some real growth over the next 10 years. Remember, we are buy and hold investors here. All right, well, that wraps up our discussion today. Thank you for watching today's episode. Let me know what you think. Is Texas Instruments undervalued at today's current trading price? Do any of you own Texas Instruments in your portfolio? Comment on your thoughts below. Also, hit that like button and don't forget to subscribe to the channel. Happy investing, everybody.